Hello everybody, spotting trend changes as they happen. And how are we going to do that? We are going to do that with an awesome, elegant, simplistic strategy that has been around for many a year, and it is known as the 10-30 moving average crossover. So you would have heard of this before. The trend is your friend until it ends. And that is where we are looking to make money with this particular strategy. We are looking to identify the start of a trend to the end of a trend and look at positioning a trade to subsequently make money. And we can do that by using a moving average. So what is a moving average? Now, if you go and ask Google, and I've directly extracted this from Google, which is why I've placed it here, it's an indicator. It's a very commonly used indicator in technical analysis. And what it does is it smooths out price action, so open and close, smooths out the closing price over a period using the sum of the close over X period of time plotted against the current day. It can help identify the start of an uptrend, the start of a downtrend. It's represented on stock charts via a line, and we saw that before where I was highlighting our 50 and our 200-day moving average. Now, the most commonly used periods for a moving average by both traders and institutional investors are the 10, the 30, the 50, and the 200. Now, what are the major differences between the 10, the 30, and the 50, and the 200? Well, fundamentally, the time periods, 10 days, 30 days, 50 days, and 200 days, retrospectively. Now, the 50 and the 200 are used by institutions as the major long-term moving average. And then the 10 and the 30 are their short-term moving averages. So what you'll find is when you get a cross, we're going to take a look now at what these crosses look like. So this is a chart of Chevron, and we can see here that we had a cross. We can see our 10-day, which is represented by our purple line here, crossed below our 30-day. And what happened? If we look at the stock trended down, and then we get a cross up on the other side. So if I move forward one, Harado, I didn't check all my slide transitions before I started. So we've had, and the market's open. So we've had a bearish cross here. So the 10 has crossed below the 30, and we've had a bearish signal. So we've traded down, and we can see here, this is our exit. This is where we've had a cross in the opposite direction, where the 10 has crossed above the 30. So if you were to trade from this period to this period, you'd probably break flat. But have a look here where we've got this bearish cross from the 10 crossing the 30, and we've trended all the way down before here. So we can see that we have an entry signal right here on our cross. Place a position, and we could trade this all the way down until we get our exit, which is when the 10 crosses back above the 30. Now, what could you do then? Could you reverse your position? So you could actually take a bearish stance on Chevron at this entry signal, trade it down until you get your cross on the reverse side, which is a bullish signal. And look at this, create a bullish position, exit your bearish, start a bullish, and trade again. Here we have a bearish cross. What do? Flip the battery in backwards, create a bearish position, trade down. You can see that whilst you've had a cross here and across here, look what the price action of Chevron did during this period. We can see we've got an entry signal right here, but look at the drop that came afterwards. So then you start thinking about, how do you couple this with your exit strategy? And what does that look like? Do you use your signal of going bearish again as your exit strategy? Yeah, you could. Do you use price as your exit strategy? Absolutely, you could. So one of the things that you could have done back here on this entry and exit is used your moving average cross to create an entry and an exit, same as here. Or you could have done it on price. You could have entered here, and you might say, when I get to 150, because 150 is a material number when it comes to support and resistance, you might take an exit. Now, this is very simple. I'm not going to get into adjustments and rolls and all that sort of stuff in today. I'm talking very simple vanilla rules to help guide you using moving average crosses, etc. So yes, you could use 150 to get out of this trade. You could enter here, and again, you could use 150 as an exit, and you would make money on this trade as it trended downwards. We can see that we had another cross up here trending downwards as well before we get a bullish signal back over here. And my little green cross hasn't actually showed up, but we had another cross on this side too. So we can see here, this is on one chart, moving average crossover is very effective at identifying trend changes. And these are not trend changes by me, Matt, or Mike, or whoever. You've got to think of the institutional volume that sits in behind it. 10, 30, 50, and 200 are material numbers to institutions. And that is where we can get these short-term runs. And this is not uncommon. It's not uncommon at all. When we start looking at, say, Ross, you can see here's the chart. Again, I haven't worked on my transition, so I do apologize. Let me just play this forward very quickly. But we can see here that we've come in, and look at this. We actually have a cross here. Could we trade this to the downside? Absolutely. Trending down. Could we trade this to the upside? Absolutely. Could we trade to the downside? Absolutely. Can we trend to the upside? Yes, we can. So you can see here that this is a sensational way to identify trend changes in stock using moving average cross and then mapping it with a strategy, matching time and price for your prediction. We'll move on to one more by way of example. Here again, we have Home Depot. We have an entry there. We have another signal there. And you can note that I've colored each one of these arrows to signal a bullish by green or bearish by red signal. We can see we had a trigger back here. Here was our bearish. We can see that the 10 crossed below the 30, runs all the way down here. And then we get a bullish signal and then a bearish. Now, in this here, this is, just remember everybody, there are no absolutes in trading, but this works 90% of the time. You can see here, until it doesn't, let me just put that disclaimer in. You can see here that whilst we've had a cross, didn't really hold and it fell and we had an exit. So you might have got out for flat here or a slight loss. But again, look at this. We've had a tick up, bullish signal, exit, bullish signal, exit. So we can see very clearly that using the 1030 as a strategy to identify trend can be very, very powerful. And I've seen a question come in here from Larry, which is very, very prevalent. Yes, Larry, you can use volume as an indicator with SMA cross, but what you generally find is you might get a volume spike back here in a couple of days, and it's that price action and the lag effect of the cross for it to carry through. So it would be more uncommon to see a volume spike and a cross happen on exactly the same day. But if you were to get a volume spike with price conviction in one direction and across a couple of days later, then yes, that would go to further strengthening your signal. And Paulina's come up with a question. Speak to the difference between simple and exponential moving average. So simple moving average is just this. It's calculated historically based on the prior period. So say the prior 10 days close plotted against the current day. And exponential looks to extrapolate that forward. So we would look to take what is the price action if we were then to extrapolate that forward by 6 days. So I know Mike used to teach back in the day when he was teaching interactive technical trading, they would actually use an EMA of 6 to get price projection for forward price action. So I hope that helps. So how do you trade these? Very simple, calls and puts. So you could either be longer call or longer put. Debit spreads, another great way that you can trade these things. Credit spreads, and if you're more advanced, butterflies, calendars, and there's a couple of other different things in there as well. But think about what environment you're trading these. Think about what environment you're trading these strategies in. If you're in a low IV environment, and we spoke about this in our market overview, calls and puts are great for a low IV environment. Debit spreads are also good for a low IV environment. Credit spreads, awesome if you've got a high IV environment. And when you're trading advanced strategies, it really depends on what strategy you're looking at. So calendars, you want your IV to be low. Butterflies, you can have your IV high. So it's really mapping what is the stock or the underlying that you're trading, and then mapping it to the strategy. And I'll go and demonstrate some of this now in TTR. Larry's come up with a question, short-term versus long-term credit spreads, 1030 versus 5200. Larry, great question. So 1030 is a short-term moving average. So what you would want to do, the 50 and the 200 moving average, also you're looking at what is the indicator to signal I'm going to take a position on the underlying. You'd want to map your strategy to both time and price. So to simplify that, if I was to pull up by way of example, let's go back here to this chart on Home Depot. So we can see here that, when we've had a bearish run, it's gone for about 2 weeks, bearish run, 2.5, 3 weeks. This is just very rough eyeballing, by the way. You could say that, if you wanted to, when you get a bearish signal, you want to take a call credit spread, and history suggests that these runs normally last for 2.5 to 3 weeks. And I'd have to have a look at where this went, but you've definitely got more time on your side in this regard. So you might say, you know what, I want to do a 2 to 3 week strategy doing a call credit spread whenever Home Depot takes a bearish cross signal. What I would encourage you to do, and what we do encourage all of you to do here at MWTC, is find a strategy you like and back test it, but couple your back testing with a strategy. So Larry, even if I was to get a 50-200 cross, I would say, well, what is my strategy? Am I going to be trading a credit spread? Yeah, put it in up top, and then you'd use 2 weeks, 4 weeks, or you could even do the long term, the 60 to 90, and we have scanners for that. So I hope that answers your question. So how do we do this? Look, there's many different ways, many different ways you can identify 1030 cross. And one of them is you can use your broker platform. So what you can do is you can come in here and you could say, I want to look at a stock. And let's go and look at Chevron by way of example. And at the moment, I've got this 50 and this 200 turned on here, but I know that Schwab, Thinkorswim, which is what I'm using now, Interactive Brokers, all major brokers in their charting tools will have the ability to apply moving averages. It would be very unlikely that someone didn't have it because they are so commonly used. And you can change these. So what I'm going to do, this blue line here is currently representing a moving average of 21. I won't get into why, but I'm going to change this to 10. And then I'm going to change my red line to 30 from 161. And I'll hit OK. So that didn't work. So I'll just change this again to 30-day moving average, hit OK. We can see here, the blue is now 10-day moving average, the red is 30. And you can see, even in your broker's platform, when the 10 has crossed below here, we've had a little bit of a dip. So this one didn't work out, but look at this, we've crossed back above. The 10's crossed the 30. We have an entry signal. Here's our bearish entry here. Here's our bullish entry. You could then create a position, trade it to the upside. You could find yourself a price target, whether it be 170, 175. You might have even picked 180 based on your analysis, create an exit strategy, or alternatively, you could take your entry here on your bullish cross to where you get your bearish exit signal here, where you cross below again. So that is also another way. And you can identify these in your broker platform very, very simply. We can take a look around again. Let's go and have a look at Home Depot by way of example. Do we have any? We have a bearish cross, trended all the way down here, bullish signal. Yep, might have got out a little bit flat here. That's all right. But then we have another bearish signal here, bullish signal to the upside, bearish signal, bullish, maybe flat, bullish run again. You go around again. You can go and have a look at something like, let's take a look at something like First Solar. And here we go. Here's that 1030 cross, bull run to the upside.